Hey everybody, my name is Good morning, February 7th, 2019. Thought I would take just a few minutes and update you on the chart while I have the time this morning. Chart in front of you is the one we've been tracking the last few weeks. Once again, started looking at it in here. Areas of resistance that we pointed to, nice consolidation above 2630 and the 50-day moving average. As I've suggested on the last couple of videos, this 200-day moving average could be a challenge for the S&P. And notice how tested it, tried it again, and we're falling off of that today. The S&P is down 22 as I speak, Dow's down 173. Another area of resistance I noticed here that technicians might look at is if we connect these two peaks. As you can see, we have a downward sloping trend here coming right at the 200-day moving average where the price is hitting that. So that's a double layer of technical resistance. So as I said in the video earlier this week, it makes perfect sense that we begin to maybe consolidate some of these gains here, maybe retrace a bit, showed you some retracement levels that we might watch for. So what we're experiencing this morning, folks, is 100% to be expected. Again, the 200-day moving average is important. You can see it failed 3 times in a row here back in October, November, and then again in December. And so certainly traders are looking for that to fail again. As you can see, it was profitable to go short the market in here and make a bet on a downturn. Some of that, no doubt, is happening today. There are some key differences just when we look at this chart, however. Notice that these other 3 times when the market failed at the 200-day moving average, each time it was trading, the S&P was trading below its 50-day moving average. In fact, here we had the 50-day with a real bearish crossover of the 200-day right in here while it was trying to penetrate that once again. Look at the difference today. Today it has recaptured the 50-day moving average. In fact, the slope of the moving average is now pointing upward. That's also a bullish technical sign. So that's quite a bit different than what we were looking at here the last 3 times the market tested and then failed the 200-day moving average. So different look here in terms of the momentum and how it's affecting the moving averages. Other couple of indicators I share with you from time to time is the moving average convergence divergence, or the MACD, and the relative strength index. Call these momentum oscillators. Notice from this last peak here to the one here a couple days ago at the 200-day, we have a downward sloping line here. We have a downward sloping short-term trend here. Notice in the MACD, it's upward sloping, as is the RSI. Those are considered bullish divergences, and these are very important and should be respected. Again, somewhat different looks. We did have a little bit of a bullish divergence in here that didn't work, flat in here on the RSI. But these two definitely are a different, more pronounced bullish look than what we had in here. Also, I didn't prepare the charts for this, but the level of short interest was lower in here, and the level of sentiment, by and large, was higher in here. And then liquidity, as I shared with you in our money market assets chart, is substantially higher in here than it was back during these 3 peaks. So you have more fuel out there in terms of folks moving from the fear of losing to the fear of losing out, cash coming in off the sidelines, and shorts covering. Folks, none of this guarantees that we're going to survive this test and move up to new all-time highs, but it's a notably different look and a more bullish look than we had back in here. As I keep preaching on the blog, in my view, virtually all of it in the near term rides on the next 3 weeks of talks between the US and China. If we do not get a trade deal, if on March 1st tariffs are ramped up as scheduled, this is not going to work. These are going to roll over. The market's going to roll over, and I can say with great confidence we will at least come down and test this December 24th low. Clearly, the rhetoric suggests it's not the likely outcome of the trade talks. The political risk for the U.S. side is huge right here, and then China's economy is seeing some real suffering of late, and they seem a bit desperate to get things turned around over there as well. So I'll be surprised if the trade talks don't go well, and therefore I'll be surprised if that doesn't end up being bullish for the market. There are other things to contend with. The Brexit talks, no doubt, will begin heating up again next week. Once we get through the China situation, or at least we get the impression that we've gotten through it, believe me, there's a whole new round of angst coming later in the year as we try to shore up a trade deal with the European Union. Hopefully, this experience that I think is 90% the trade war is an eye-opener to all parties, and the European talks will be less tumultuous than the Chinese talks have been. The market has sent a very definite signal that it will have nothing to do with the global trade war, and the global economy, as I posted earlier today, really is suffering. There's no question. I'll leave it there. Talk to you again very soon. Thank you as always for watching and listening, and have a great day. Bye-bye.